Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is certified financial planner and registered investment advisor, Rob O'Dell. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about Year End Charitable Giving for consumers. We're going to address immediate gifts of cash, low basis assets, and donor advised funds, all from Rob's popular mind map seminars. And I have to say, these are really great. I love this whole idea of getting off an analog timeline and spreading this out just from a non-linear point of view. Yeah. And most people are.
Exactly, most people are non-linear.
Okay, when we're talking about, these are tactics that we want to make sure our advisors understand so they can share these with the consumer. And we've learned we have to talk differently, right? No MBA language. No, we try to stay from acronyms as much as we can. But let's walk through some of the basic things that we want to go to our clients. With 3 or 4 weeks ago, we still can get some of this done.
Some of the stuff you definitely can get done with a little bit of time that you have going. It's the simple things you can do. So let's begin by talking about immediate gifts to charity. And the first thing I want to talk about is the income tax deductions if you give cash gifts to charity. So most people at the end of the year are giving to public charities. I'd say 99.5 are doing that, so I'll focus in on that. They can deduct up to 50% of their adjusted gross income on cash gifts to charity. So if someone has $100,000 of income, the maximum deduction they can take in 2015 is $50,000. If they give more than that in cash, it moves into 2016 and beyond, and they can carry forward up to five years after the current year. Now, the thing is, advisors, how they can really distinguish themselves, if they have clients who are writing checks to charity, and most people are, and they have low basis stock or mutual funds, a great way to talk to them about how they can improve their tax planning situation is give the low basis asset and not the cash. The cash, after tax cash, is always king. So let's just talk about the tax ramification of that. Most people have long-term capital gain property. They've held the mutual fund or stock for more than 12 months in one day. If it's less than that, it's short-term property. If they give the stock or mutual fund, they get to deduct the full fair market value. Now, how they apply it against their adjusted gross income is that they can only deduct up to 30% of your adjusted gross income. But here's the biggie: they avoid long-term capital gains tax.
Now, that would include not just traditional capital gain, but the Obamacare tax on top of that.
That is correct.
So
that is correct.
It's a sizable number.
It's sizable. If you do it a private foundation, it's 20%. But again, this time of year, you're looking at public charities and you're avoiding long-term capital gain. Great way to give it. And the cash that they would have given to charity, go spend it on Christmas presents. Go reinvest into the market. Go buy that favorite stock or mutual fund back. You get a brand new cost basis.
Wow.
Yeah, it's powerful stuff.
That.
So let's talk about donor advised funds here for a second. Donor advised funds are my favorite planning topic. I love working with donor advised funds. What a donor advised fund is, think of it as a charitable mutual fund, if you will. It's a community foundation, sets it up. A client can donate stock, mutual funds to this account, get a full income tax deduction, sell it, no capital gains, and then diversify their giving and be able to send that money out to various charitable organizations. Or they can let it sit in there and figure out later where they'll give it to. So this time of year, let's think about this. You're sitting in December. A client wants to do a charitable gift. You advise them that they can do this, but we have 3 weeks to decide what charities to give to. They can give assets to the donor advised fund, get the income tax deduction, avoid the capital gains, and then decide in 2016 and beyond which end charities are actually going to get the grants from that donor advised fund.
Now, they can only make the suggestion to the...
that's a good point.
Right?
Yeah.
But most of them play ball.
Most of them play ball. The good ones do.
So the client, the donor, can suggest to the donor advised fund, here's where I want it to go.
Correct.
And they're pretty much going to play ball. They'll never get a donation.
Well, if you think about it, the third largest charity in the United States is Fidelity, the Fidelity Gift Fund. They started this back in the late 80s, early 90s, and they have billions of dollars in there, and because they help facilitate their clients' charitable gifts. Now, there's 3 main sponsoring types of donor advised funds. You have established charities. Some of the large charities, they have their own donor advised program, but usually they have rules saying that if you set a donor advised fund up with us, you must give 25% a year of your grants to us. You got to play by their rules. And often advisors are not included into the mix. They're out. Community foundation, local community foundations. You have the Collier County Foundation, where I live down in Naples, Florida. They will sometimes work with advisors, but typically they want a larger gift to the donor advised fund before the advisor gets involved. And typically they might suggest that we were going to make grants inside this geographical region. Maybe it's the county, maybe it's the state. Sometimes they'll let them go outside of that. But my favorite type are the independent donor advised funds, the community foundations. I happen to have one favorite one, American Endowment Foundation in Hudson, Ohio. Give them some free advertising here. They're great. I've been working with them for almost 20 years now. They allow the advisor to be involved at every step of the process. They allow the clients maximum flexibility on suggesting what charities to give to. Really, there's no restrictions on where they can go as long as it's a United States 501c3 charity.
So these are pretty straight up end of the year issues that you can do. Donor advised funds, there's really very little or no cost at all.
No.
And we really have access to the places we still want to give to.
Right.
So this is really a pretty good deal. And I say if you're looking to help your clients at the end of the year, this could be the way to go. For more information on charitable giving with immediate cash gifts of cash, low basis assets, or donor advised funds, just click on the landing page address in the video description. We'll be right back with more from Rob O'Dell.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're talking about year-end charitable giving for consumers. We're going to address deferred gifting with charitable gift annuities and charitable remainder trusts, all from Rob's popular Mind Map seminar series. Well, I'm really excited about this because this is stuff I can do. I can defer it. I can do it before the end of the year, but I really don't have to make much decision making if I understand it.
Right, and these are the things where the deferred gift is actually to the end charity. So this is stuff that you can set up now that will give your client an income tax deduction, give them a lifetime of income, and then ultimately it goes to charity, usually upon their death or if they're married, the second death. But this is something that can get done before the end of the year. That's very important to know. The first one I'm going to talk about is the oldest form of planned giving. It's known as a charitable gift annuity. Started back in the Middle Ages. People who had lots of land would give it to the Catholic Church in exchange for income. While they're still around today, they've been around for a very long time. The concept is very basic. A client will give cash or stock to a charitable organization. They become, in essence, a credit or a creditor to that organization, which they're going to get payments for the rest of their lives. They get an income tax deduction. They get tax-favored income, kind of like an immediate annuity has exclusion ratio income. Well, this has exclusion ratio income where they get a portion as return of principal. If there's a low basis asset, they might have a little capital gain in that exclusion ratio, and they'll have some interest income coming to them. It's very simple, and that's a big advantage. The other thing, it's very, they can accommodate small gifts. So if you go to the American Cancer Society or any blue chip charitable organization, they might start at $5,000. Whereas we're going to talk about in just a second, a charitable remainder trust, you're probably looking at $250,000. So this is something that you can go to your clients now with, and you can definitely help them get set up and get it done before year's end.
Low entry.
Low entry.
Very low entry.
Very low entry.
So we're talking pretty much anybody could do this.
Correct. So if you have someone who may not have a high net worth, they might be middle class, this is something that would work. And it's usually typically an older clientele. So someone probably 70 plus will be benefited by a charitable gift annuity.
Okay, but now that's one thing. Now, for your higher end clients.
Right. Now, I'm going to say one last thing. Do some credit work on the charitable organization because you want to make sure the charity is going to be around for your client's lifetime and hopefully beyond that. So as opposed to giving it to Joe's charity, maybe give it to the American Cancer Society.
Sure.
That's what you do. Now, let's talk about the charitable remainder trust. This is a good way to give a deferred gift. It's a split interest gift, as we call it, signed into law in 1969. The donor makes an irrevocable gift to a trust. That trust does two things. It pays the donor income, typically on a percentage basis, and then upon the death of the income beneficiaries, if it's a single person or a married couple, whatever's in that trust goes to the name of the charitable organization. The advantages in doing this, and typically the type of person you want to find who would be a candidate for this is if they have a low basis stock or real estate that does not have debt on it. And they want to diversify. They want to divest themselves of that asset. They can give it to the charitable remainder trust. They would get an income tax deduction based on the present value of future gifts to charity. Then they can sell it, and there's no lump sum capital gains tax. They receive income for as long as they live. That income comes out to them taxed either at capital gains or ordinary income rates. It's a 4-tier accounting. I'll save that for another day. And then upon their death, whoever's named as charitable beneficiary receives the corpus. Often it can be a donor advised fund like we talked on the last segment.
Who would you identify from an age point of view maybe, or from or money? How much money are we looking at? Are we to kind of the entry level?
Yeah, that's a good question. I would probably look at, the asset going into it, initial assets going in, probably $250,000. So it might be someone who might work for a company their career. They've acquired company stock. They can't afford to give all that away to charity now because they might need it for income. So someone who needs income in retirement. So it's probably someone 65 years old and older. They could be 60, but the younger you get, the lower your income tax deduction.
Now, I gave it away, and I know I'm going to get it back if I need it because I'm still not sure if I'm going to get it. But let's say 10 years down the road, I don't need it.
Well, yeah, that's a good point, Steve, because in fact, I've had the privilege to do several of these where we have clients, for whatever reason, said, you know what, this income, I don't need the tax liability on it. I have plenty of other assets to live the rest of my life comfortably on that I'm accustomed to. In many cases, you can terminate this charitable remainder trust and send it in advance while they're still alive to charity. And there's some great tax benefits that go with that. So
I like the flexibility of what you said. I don't think I'm going to need this, but I might.
Right.
10 years down the road, oh, it's great. I don't need it. I could go ahead and terminate it. And then that, whatever gift is left, whatever the amount is left, that becomes even a greater tax advantage.
Yeah, you get a tax benefit coming back. And there's been some cases, and I'm not to really get into the weeds here, but we've had one client back after 2003, 2002, when we had those bad market years, said, you know what, I need that principal for my charitable remainder trust. So they terminated it, but they said, I'll take my income interest back, and charity, here's your charitable interest. Now they paid tax on the income interest they got back, but they had lost carry forward from having those bad 3 years in the market. So that's possible.
So there's a lot of flexibility. If you have it has to be pretty much an affluent client. Anybody that's giving away $250,000 has got to have some money, and probably a little older in the 60s or so forth. But this is an excellent tool, and I like it has so much flexibility, and I can pivot.
Yeah, and again, going into one of these things, like going into marriage, you don't want to think about divorce and trying to think of your exit plan, but at least it's nice to know that you can do it. There's some hoops you jump through, but you can accelerate or terminate depending on your circumstances 10 years from now.
Well, I love the options, and I love having exit strategies in case I have buyer's remorse.
Exactly.
Well, for more information on charitable giving with deferred gifting, with charitable gift annuities and charitable remainder trust, just click on the landing page address in the video description. And for more information on all our shows, seminars, and workshops, just follow us out on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.